Pros rarely recommend global diversification, and for a while there, they didn't have to. It's changing. I'm Dean Lolkin, investing veteran and private credit CEO, here to help you grow your wealth. Today, I'm going to show you why allocating just 15 to 20% of your equity portfolio to international stocks might reduce risk, diversify sectors, and improve long-term returns. And you don't need to overhaul your portfolio to do this. For the last decade plus, US stocks, especially tech and led by tech, outperformed. So the pros that you hired chased performance and global diversification fell out of favor. But here's the rub. Over the long run, global diversification reduces volatility and improves risk-adjusted returns. So let me get more specific. Look at two recent decades, the 80s and the early 2000s, 80 to 89 and 2000 to 2009. Both showed significant outperformance by foreign stocks. US stocks lost money in the early 2000s. The S&P 500 returned negative 0.9% per year. In that same decade, international developed markets returned a little over 1.5% per year, while emerging markets got you 10% annualized. The outperformance was more dramatic in the 80s. Remember, Japan roared, and that led foreign stocks to beat the US by 5% annualized. That's a knockout, a KO in investment terms. In the 2000s, the tech bubble burst in the US, but value-driven international sectors like materials, energy, and industrials boomed. Different economies cycle at different times. And when the US stumbles, Europe or Asia may thrive. Currency differences also provide a hedge. Remember, what the dollar does versus foreign currencies matters when you have an international portfolio. So when the dollar weakens, guess what? Foreign returns rise for US-based investors. Today, non-US markets are cheaper, more value-oriented, and less tech-heavy, and they're starting to get some attention. Owning them adds balance and reduces single-country risk. You can start very simply. Allocate 15 to 20% of your equity portfolio internationally. You can use simple funds like Vanguard, simple cheap ones like Vanguard FTSE Developed Markets ETF, VEA, that's the ticker, for Europe, Japan, Australia, and other developed markets. You can also add Vanguard's FTSE Emerging Markets ETF, VWO, that's the ticker, maybe around 5% for long-term growth potential and a direct play on further dollar weakness. You're not abandoning US stocks, just adding some balance, reducing risk, and capturing global opportunity. Again, this applies to your equity allocation. Make sure your total investment mix reflects your goals, risk profile, and time horizon. Cap weight, equal weight, global, all working together. Subscribe to the Dean's List now. Let's grow our wealth intelligently.